The global economy is entering a new phase, one defined not by acceleration but by fragility. Growth, once driven by synchronized recovery, fiscal stimulus, and exuberant innovation, is now walking a tightrope stretched between opportunity and instability. The latest projections suggest expansion may hover around 3% globally, but the texture of that growth feels brittle. Beneath the surface of rising GDP numbers lies a network of exhausted engines, slowing productivity, aging demographics, and lingering post-pandemic dislocations. We are witnessing the deceleration of a system that once thrived on abundance, cheap credit, and efficiency. The challenge today is that the world has changed, but many of our assumptions have not. Monetary policy has lost much of its precision. For years, central banks stimulated demand by keeping rates near zero, pushing capital into risk assets and compressing yields across the world. Now, inflationary aftershocks have forced a reversal. The cost of capital has reset. Governments, corporations, and consumers are suddenly confronting a new reality, one where debt, accumulated under the illusion of permanence, must now be serviced in a higher rate world. This is not a minor adjustment. It's a structural shift that threatens to rewrite valuation models, business incentives, and global capital flows. When growth is fragile and the margin for error narrows, every misstep compounds into systemic risk. Meanwhile, global trade, the oxygen of modern growth, is becoming less reliable. The geopolitical order that sustained decades of prosperity has fractured, regional blocs are forming, and economic nationalism is resurfacing. Supply chains once optimized for speed are being re-engineered for resilience, introducing friction where there was once flow. For investors and innovators, this fragmentation brings both risk and opportunity. It means inflation may remain stickier than central banks desire, but it also opens the door for localized innovation, nearshoring, and technological substitution. Fragile growth does not mean the end of progress. It means the end of the old kind of progress. Emerging markets, often the engines of global expansion, now face a more complicated backdrop. Currency volatility, commodity dependence, and external debt pressures are converging in ways that could destabilize entire regions. Yet paradoxically, this fragility might become the breeding ground for new leadership. Nations that embrace structural reform, digital transformation, and financial transparency will attract capital and talent at unprecedented speed. The others, those clinging to outdated frameworks, may find themselves isolated in a global economy that is reconfiguring in real time. Fragility, then, becomes a test of adaptability. Technology, too, plays a dual role in this delicate balance. Artificial intelligence, robotics, and biotechnology are injecting productivity potential that could redefine the next decade, but they are also distorting short-term expectations, fueling speculative valuations, and widening inequality between those who adapt and those who do not. This is what makes the current landscape so complex. The same innovations that promise exponential progress are, in the short term, amplifying volatility and uncertainty. The transition between the old economy and the new is rarely smooth. It is turbulent, emotional, and misunderstood. In this environment, leadership matters more than momentum. Growth will not simply resume because it has in the past. It will have to be engineered through bold capital allocation, disruptive innovation, and policies that prioritize long-term productivity over short-term appeasement. Investors must abandon the comfort of backward-looking models and lean into the asymmetry of transformational change. Fragile growth doesn't mean failure, it signals an inflection point. The question is whether we interpret it as a warning or an invitation. The world stands at a threshold where incremental thinking is no longer sufficient. Those who recognize the structural nature of this fragility will see through the noise. The turbulence ahead will not be kind to complacency, but it will reward conviction, adaptability, and foresight. This is the moment when clarity of vision becomes the most valuable asset in the world. The debt story unfolding across the global landscape is not just a financial headline, it's a defining force shaping the next economic era. Over the past decade, the world has been living through an extraordinary experiment in liquidity. Cheap money fueled consumption, leveraged growth, and amplified valuations across nearly every asset class. But as interest rates normalize and inflation lingers, the era of effortless credit is ending. What we face now is the reckoning phase, a reality check where the accumulated leverage of years past collides with higher financing costs and slower growth. Global debt has surpassed 250% of GDP, a staggering number that reflects not prosperity, but dependency. It reveals how the modern economy has come to rely on debt as a substitute for productivity. This accumulation didn't happen by accident. It was the inevitable outcome of a system optimized for expansion at any cost. Governments borrowed to sustain spending. Corporations leveraged balance sheets to fund buybacks, and households expanded credit to maintain lifestyles that income growth could no longer support. For a while, this cycle appeared sustainable. Rates were low, inflation was benign, and liquidity was infinite. But when inflation reappeared, it rewired the entire dynamic. The same mechanisms that once stimulated growth are now transmitting risk. Every rate hike compounds pressure on sovereign budgets, corporate margins, and consumer balance sheets. The world has pivoted from a debt-fueled boom to a debt-constrained slowdown. The deeper issue lies in how this debt interacts with fragility. Many countries face the paradox of needing more fiscal support just as they can least afford it. Fiscal deficits are widening at the exact moment that borrowing costs are peaking. This tension between social need and financial prudence is stretching political systems to their limits. Nations with weaker currencies or limited reserves are particularly vulnerable. Emerging markets, heavily reliant on dollar-denominated borrowing, are seeing capital outflows accelerate as investors retreat toward perceived safety. The risk is no longer confined to isolated economies. It's systemic, embedded in global bond markets, pension funds, and shadow banking systems that depend on confidence to function. Corporations are not immune either. The years of easy financing created layers of leverage that masked inefficiency and overvaluation. Zombie companies, those surviving only through cheap credit, now face an existential moment. Refinancing debt at higher rates will expose business models that were viable only in a world of zero interest rates. The transition from abundance to scarcity in liquidity will be merciless. Capital will flow to innovation and productivity, not inertia. This cleansing process, while painful, could ultimately reset the foundation of capitalism itself, moving from debt-driven speculation to efficiency-driven creation. The financial system's interconnectedness adds another layer of vulnerability. In a digital, high-speed world, risk can transmit faster than policymakers can respond. Contagion no longer requires bank runs in the physical sense. It happens through algorithms, derivatives, and liquidity mismatches that unravel confidence in hours, not weeks. Central banks, once the ultimate backstop, are now constrained. Their credibility depends on fighting inflation, but their stability mandate demands intervention. They walk a narrow path between tightening too much and rescuing too often. This policy duality will define the next phase of market behavior, yet even in this high-risk environment, opportunity still exists for those who can interpret the signals correctly. Innovation continues to be the ultimate deflationary force, and technology can play a critical role in reducing costs, increasing transparency, and unlocking productivity in sectors long trapped by inefficiency. Financial systems that embrace digital transformation, tokenization, and decentralized transparency may navigate this reset more effectively than those clinging to legacy debt structures. The coming years will favor visionaries who can allocate capital to exponential technologies rather than to incremental debt expansion. The debt overhang is not simply a warning sign, it's an invitation to rethink growth altogether. True resilience will emerge not from how much liquidity we inject into the system, but from how intelligently we redirect capital toward innovation, sustainability, and real productivity. The age of borrowed time is ending. The next phase belongs to those prepared to build on earned value, not leveraged illusion. The global economy is shifting under the weight of forces that extend far beyond markets or monetary policy. The assumptions that once anchored globalization, stability, open trade, and predictable cooperation are dissolving. We've entered an era defined by geopolitical recalibration, where power, ideology, and supply chains are colliding in ways that could reshape the economic order for decades. The old system, built on efficiency and interdependence, is fragmenting into regional ecosystems driven by security, resilience, and national interest. It's a profound transformation, one that introduces friction, but also unlocks a new frontier of innovation and opportunity for those who adapt early. Trade, once the engine of global growth, has become a strategic weapon. The trust that underpinned free movement of goods, capital, and technology is eroding. Tariffs, export controls, and sanctions, once exceptional tools, are now standard instruments of policy. What was once an invisible web of cooperation has become a visible battleground of economic statecraft. The world's leading economies are no longer competing merely for market share. They're competing for technological dominance, resource control, and ideological influence. The result is a new kind of volatility, one that doesn't come from earnings or inflation, but from diplomacy and conflict. This realignment is exposing deep vulnerabilities in the structure of global trade. Supply chains optimized for efficiency have proven brittle under pressure. The pandemic was the first shock, but it was only the beginning. Energy crises, semiconductor shortages, and critical mineral dependencies have revealed how interconnected and fragile the system truly is. The response has been swift. Nearshoring, friendshoring, and reshoring are reshaping the geography of production. Yet, as nations rush to secure autonomy, the cost of redundancy rises, inflationary pressures linger because resilience is expensive. We are learning, perhaps belatedly, that efficiency and security rarely coexist without trade-offs. At the center of this reordering is technology, a double-edged sword in the geopolitical contest. Artificial intelligence, quantum computing, and biotechnology are no longer just commercial frontiers. They are strategic assets. Nations understand that whoever controls these technologies will shape the future of productivity, defense, and influence. As a result, cross-border collaboration in high-tech sectors is giving way to selective alliances. Innovation is becoming fragmented along geopolitical lines, with rival standards, data ecosystems, and digital currencies emerging in parallel. The consequence is both risk and possibility. While fragmentation limits scale, it also accelerates experimentation and localized innovation. Energy and commodities, once neutral enablers of trade, have reemerged as instruments of leverage. The transition to renewable energy, while inevitable, is adding another layer of complexity. Dependence on rare earths, lithium, and critical metals introduces new geopolitical choke points. Nations are racing to secure supply, form alliances, and build processing capacity. What we're witnessing is a silent reshuffling of global influence, one that will determine not just who produces energy, but who controls the raw materials of the digital age. The next decade will not be defined by oil politics, but by battery, data, and chip politics. Investors must recognize that volatility born of geopolitics behaves differently than volatility born of markets. It cannot be modeled, hedged, or fully predicted. It demands agility and awareness. Markets that once moved on earnings now move on headlines, policy shifts, or even tweets. The margin for error in global strategy has narrowed. Capital that is blind to these shifts will be punished. Capital that anticipates them will thrive. This environment rewards those who think probabilistically, who can read signals, not noise, and position themselves in sectors that benefit from the very chaos others fear. Despite the tension, this transition carries profound creative potential. As globalization retreats, regional innovation ecosystems are emerging. Nations are investing in domestic manufacturing, local supply chains, and technological independence. The short-term disruptions will be painful, but the long-term outcome could be a more diversified, adaptive, and robust world economy. Geopolitical vulnerability, paradoxically, may catalyze the next wave of technological acceleration. In the end, disruption has always been the birthplace of reinvention, and this era, volatile as it may be, is no exception. Every technological revolution begins with euphoria. It's the natural response of a world glimpsing the future, an intoxicating blend of optimism, innovation, and capital inflow. Yet, history reminds us that euphoria often breeds distortion. The great paradox of progress is that transformative innovation and speculative excess tend to move together. Today, as artificial intelligence, robotics, and biotechnology redefine the boundaries of what's possible, we find ourselves in that familiar tension between visionary promise and dangerous overconfidence. The technological renaissance unfolding before us is real, but so are the signs of an asset bubble forming beneath its surface. Capital has flooded into innovation at an unprecedented pace. Venture funding, equity valuations, and forward multiples in certain sectors have detached from fundamentals. The market is treating disruption as destiny, not probability. This is the classic psychological shift that accompanies every bubble. Conviction turns into narrative, and narrative becomes valuation. When investors begin pricing perfection into imperfect realities, fragility creeps in quietly. The underlying technologies, AI models, autonomous systems, synthetic biology, are extraordinary, but their monetization cycles remain uncertain. We are investing in future cash flows that have yet to materialize, assuming linear scaling in a world that is anything but linear. The momentum fueling this phenomenon is not limited to equity markets. Private valuations have soared, startups are raising capital at record multiples, and tokenized assets are reemerging as speculative vehicles under the banner of innovation. The danger lies not in technology itself, but in the collective illusion that exponential innovation guarantees exponential returns in the near term. History shows otherwise. The dot-com era proved that even world-changing technologies can experience catastrophic valuation resets when expectations outrun adoption. Those who survive such cycles are the ones who build through disillusionment, not around it. In parallel, the financial environment amplifies the risk. The global economy is still absorbing the shock of rising rates and slowing growth. Liquidity is no longer infinite. As credit tightens, speculative assets lose their cushion. The same investors who rushed in during abundance now face capital discipline in scarcity. Margin calls, funding constraints, and valuation markdowns can trigger domino effects that cascade through both public and private markets. When liquidity dries up, even fundamentally sound innovation can become collateral damage. This is the hidden danger of overconcentration in thematic trades. What was once vision-driven can turn momentum-dependent. Another layer of complexity arises from how technological breakthroughs shape behavior. Artificial intelligence, for example, is accelerating not only productivity but also speculation. Algorithms are amplifying trends, trading narratives, and volatility itself. Technology is now both the subject and the mechanism of the bubble. We are living in an era where financial markets are driven by code, and the same code can reinforce emotion. This feedback loop magnifies both the ascent and the correction. It rewards speed over understanding, sentiment over substance, when the correction arrives, and it will. Those who lack conviction in the underlying science will be the first to capitulate. Yet this moment should not be misunderstood as a reason for retreat. The excesses of capital do not invalidate the revolution, they simply distort its timeline. Innovation cycles are uneven, but they always converge toward real value. The internet did not disappear after 2000, it matured. The same will be true for artificial intelligence, blockchain, and next-generation computing. What we must cultivate now is discernment, separating the signal of long-term technological transformation from the noise of short-term speculation. The market will eventually rediscover fundamentals. Those anchored in them will emerge exponentially stronger. The path forward demands both courage and discipline. Technology remains the most powerful deflationary force in the world, capable of restoring productivity to a system burdened by debt and demographic decline. But progress requires patience, and valuation excess must first burn itself out. The coming correction will not destroy innovation, it will purify it. True visionaries understand that bubbles are not the end of revolutions, they are the price of awakening. The key is to stay invested in transformation, not in mania. Those who build through volatility, guided by conviction rather than emotion, will inherit the future once the noise fades and clarity returns.